Individual equities are moving a huge amount. UBS is the example this morning, but you look at tech last week, huge amounts, like single stocks that are worth trillions of dollars moving around 6, 7, 8, 9%. What does that tell you about investors' understanding of how to value these businesses?
What it tells me that it is all about earnings. So what Jane has described, this environment of growth not rolling over as much as we feared and potentially cuts coming in, there is upside for earnings going forward. And what we are noticing in this reporting season is the market is really focused on the delivery. So the companies get awarded much more in the previous quarters for the beats, and they get punished much more than in the previous quarters for the misses. And of course, there is a difference between the different individual regions. Yep. So I would put it this way: the U.S. market is priced for perfection, which means the corporates there need to deliver more, while in Europe it was priced for recession a few quarters ago, and now our model suggests it's fairly priced. So delivery in line with the analyst forecast, it's enough to satisfy the market, and we are seeing it on individual stock basis.
We are struggling to understand what is happening with the global economy. How much harder does that make your job right now? I don't know whether inflation's going to be going up, going down, whether the Fed's going to be hiking or not, what the ECB is going to be. There are so many unknowns right now. How does that affect your models?
So it's been a very complicated cycle, if you can even call it a cycle, right? Because you could argue different regions are at different points in the cycle. So in Europe, at least, what you can argue that we are experiencing here early cycle dynamics. So growth was very low, borderline recession. European EPS actually was in a recession if you excluded the EPS strength out of banks, right? So we are moving higher on the GDP, on the EPS from low levels, positive delta. Then in the US, of course, it's the deltas might be negative going forward because we worry the strong growth that we've been noticing out of the US could be rolling over. And now the question is how much is going to roll over? That's the big question for equities, right?
Beata, good morning. So if US tech was the big story of, well, it seems like forever, but certainly the last 6 months, and it remains so, what is the big equity story of the next 6 months?
So for us, it's equity broadening. If EPS indeed continues to do well, you broaden into cyclicals. So it's not only about value, it's not only about growth, but being in the right sectors within the cyclicals. So out of growth, our preferred way of playing it is tech indeed. We also like luxury goods in Europe, and within value, it's basic resources.
OK, so those are the areas of focus. What about the tensions that we see between Europe and China right now in a whole host of different sectors? We've had slightly better news on the drinks sector overnight, maybe, but certainly there are areas of tension around cars, EVs, areas of renewables, medical equipment, medical devices. In so many areas of innovation, it seems hard to say where the benefits are going to fall, who's going to reap the rewards. How do you invest around that with that kind of uncertainty, Beata?
Absolutely. So that's an ongoing process. This geopolitical uncertainty is going to stay with us for some time. And trade tensions is something that we worry about a lot. And I've mentioned we are pro-cyclical, but one part of the European equities that we are not so bullish about, we are indeed underweight, is the auto sector.